Welcome to the McAlvany Vault, where we revisit classic shows and highlights from 2008 and on.
Russell, we would love to know what you believe to be the most important factors affecting real rates of return over the next decade.
Over the next decade, the most important thing for everybody to consider is what the future rate of inflation is going to be. I think many people for the past decade and arguably for 2 decades have got used to living in a world where the rate of inflation has been falling. And that's been a benign environment for many financial assets. In fact, most financial assets, because it's a benign environment for both bonds and equities. A period of rising inflation or rising inflationary pressure, both are equally bad for equities. And what I mean by rising inflationary pressure is that inflation which doesn't necessarily get out of hand, i.e. not a rerun of the 1970s, but the inflationary pressure which forces central bankers to run a tighter monetary policy over the next decade than they have done over the past 2 decades, with negative implications for equity valuations and growth. So I think it's a completely different environment. One of the most dangerous things you can do, I believe, for the next decade is to extrapolate the last 2.
So what would cause sort of an upward course of interest rates to become the new established trend?
Yeah, I think a great place for investors is by reading Alan Greenspan's book. The first half is about Alan Greenspan, but the second half focuses on big economic issues for the next 30 years. One thing he focuses on is where the global disinflation has come from. He lays it very clearly at the door of globalization, not central bank policy. He makes it absolutely clear that the central bankers adjusted policy to be commensurate with changing global trends, but they did not bring down inflation. He then says that the powers of globalization will reverse to reduce higher levels of inflation. And he particularly focuses on 2 issues on this globalization story. Number one, the flow of workers from the command economy to the market economy globally must come to an end. It is a structural shift. It must slow down. Moving those workers from highly unproductive means of working in the command economy to the market economy has been very disinflationary, particularly the Chinese ones have produced goods for the globally traded goods market. And secondly, and just as importantly, most of these people have not been able to consume the way we consume in the West, because particularly in China, they haven't been facilitated with consumer credit.
Russell, do you see that shift changing at this point? Do you feel that at this point the Chinese are starting to become more and more consumption-based?
Yeah, absolutely. I think we've seen the important inflection point for that just in the last few years. I think the markets have not picked up on it as much as they should have. Everyone's focusing on China driving up commodity prices, but they're not focused on the change to consumption, which really can drive up the price of most everything. And that is, if you go next time you go to a store, look around and see what's made in China, and imagine what would happen that instead of falling in price, which those things have been doing for at least 15 years in the United States, they begin to rise in price for one simple reason, and that is that Chinese people themselves start to buy them. For many decades, Chinese people have not been facilitated to purchase many consumer durables. But if you look back in the history of America, you'll see that the great enfranchisement of the American consumer begins in 1919 with the invention of consumer credit, particularly General Motors Acceptance Corporation, and that creates the consumer society. It's only in the last 2 years, and I think many of your listeners might find this surprising, only in the last 2 years has anybody in China been able to get any credit to buy anything. Remember, they have a command economy banking system which borrows money to lend to state-owned industries. So this is consumer credit coming from an extremely low base. In fact, I think the only 2 economies in the world where consumer credit would be as low as this would be North Korea and Cuba. So that gives you some idea of the spent-up purchasing power in China. Once the Chinese start to consume more normally using credit, then I think we're looking at higher prices. And the important thing is this is not a 2008, 2009, 2010 story. It's really a story which could last decades. If you think how long the march of the consumer has progressed in America, which it's a decades-long story, not a 1 year or 2 year story. So there'll be a business cycle against the background of the structural shift. But it's that key structural shift. Chinese people buying more of the goods they produce, which is going to give us greater inflationary pressure.
Yeah, certainly here in the United States, the pillar of support for our economy is the consumptive habits of a healthy middle class. We're now at 72% of GDP, which is attributable to consumption, and that's been growing steadily since the end of World War II. And as you said, that really got kicked off in 1919 when we didn't have to have the cash in our pockets to buy the goods that we wanted. We could charge it. We could actually borrow funds for those consumptive habits. So what you're seeing is the major shift in terms of an inflationary trend. We've had the privilege in the West, both in Europe and the United States, of buying cheap goods from China. because they've been exporting those goods. Now we're actually competing or moving into an era where we are competing with a burgeoning or growing middle class in their own country who wants those same goods. And so essentially you're looking at a bidding up in prices for those goods.
That is correct. To put the numbers on, as you've mentioned, consumption is about 72% of the U.S. economy. It's 38% of the Chinese economy. Now, other low-spending economies like Japan are notoriously low-spending economy, but it's 57%. Consumption is 57% of GDP in Japan. Even undeveloped countries like India, you've got a number much closer to 60%, but China is 38%. So it gives you some idea how far behind they are. But it's not just this consumption thing. I want to make that absolutely clear. I've just spent a week on a train going through China trying to answer the second part of the question that Greenspan poses, which is, has the shift of the labour force from the command economy to the market economy, has it peaked and is it slowing down? And if that begins to happen, then Chinese workers begin to get greater pay rises. And this is a new structural change, not just a cyclical one. We're looking at higher levels of wage growth in China. And for a whole myriad of reasons, I came to a very strong conclusion that that is exactly what's happening in China. That the period of a massive, and it's one of the biggest it's the biggest mass migration in history since America, the opening of the floodgates into America, right up until 1920. It's the biggest mass migration since then of Chinese people moving to the coast and building goods for export. That has really come to an end. So there's two parts of this equation going wrong for the West, if you like, simultaneously. Yes, we're competing with more middle-class purchasers in China. But secondly, that source of very cheap labour in China has come to an end because the massive reallocation of labour has come to an end. And the growth in the workforce is collapsing. That's not a great surprise to anybody, given the one-child policy in force since 1979.
And you described that as a structural change. Does that have to do with the employment contract law enacted in January of this year?
There's a whole host of reasons why it's structural in nature. The first one is just simple, that if you sort of move people from the command economy to the market economy, one day you run out of people to move. Now, China hasn't run out, but the pace has slowed, so it's inevitable if you go through any structural change that it comes to an end. But you're right to mention the labour law. It's very important because the Chinese themselves, or the Chinese government, has made several key legislative changes in the last couple of years, which are really telling all of us what they want the economy to become. And one of those is that labour law, which is giving labour greater rights relative to capital, clearly increasing their bargaining power relative to capital, and clearly going to lead to a period where they get higher wages. A higher share of GDP will be with labour. Now, that's very good for consumption. It may not be good for corporate profit margins in the short term, but it's very good for consumption. And I think it feeds into, every Chinese leader has to have a buzz phrase to sort of characterize what he wants for his economy. And the buzz phrase of the current leadership is the harmonious society. And I think if you look at the policies they've introduced, this one, revaluing the currency, bank reform, the harmonious society is the consumer society. And that's a contentious thing to say, but I think that's where the harmonious society is leading us to. So the labour law is an important part of this. The best way to enfranchise a consumer is lend them money to buy things and give them a big pay rise. Well, across China, many people have got a 15% pay rise. And this year, and if you want to look at that in dollar terms, you're looking at nearly a 20% dollar pay rise plus your first ever credit card. It's a potent combination.
It seems like the consumer society being launched there in China is something that here in the U.S. we just have no idea is happening. No idea is happening. And so you say, this is something that's becoming more obvious. You just spent time doing research in China. That's what you see on the ground.
Absolutely. It's even coming through in the economic figures. Now, economic figures in China are notoriously unreliable. And I think picking up consumption is particularly difficult because a lot of it is not measured properly. But all the figures that are picked up show that consumption is picking up at the expense of exports. Remember that China is largely or partially still a command economy. And one of the advantages of a command economy is that it goes in the direction the government wants it to go. As we found out in the Soviet Union, it can be generations of misallocation of capital which show up eventually. But in the short term, it goes the direction the government wants it to go. And they clearly want it to go in consumption. The question your listeners really have to ask is, why did the Chinese spend 30 years devaluing their currency by 70% and then suddenly start revaluing it if they really believe they're going to grow via exports? Why did they wait 30 years to reform the banking system? Remember, the Russians effectively obliterated their banking system within the first few years and started from zero. And why did they wait 30 years to give workers rights to get higher wages? There must be a good reason why the government is putting all these policies in place. There's several things crossing over. Go to China and you'll see it happening. 2, even the economic statistics are picking it up. And 3, government policy is clearly pushing China in that direction.
Just a reminder, you're listening to the McAlvany Weekly Commentary at McAlvany, McAlvany.com. Today we're interviewing Russell Napier. And Russell, do you see the market economy in China overwhelming the command economy, overwhelming the government's ability to place these assets where they want?
No, I think that's, in the long term, that must inevitably be where we get to, but we have to be very careful as to what the long term is. The core of any command economy is its banking system or financial system. Now, that is minority owned by foreigners. Citibank own a portion, Bank of America, I think, own a portion. Lots of European banks own a portion, but they own minority interests in the Chinese banking system. As long as the Chinese government is the majority owner of its financial system, the misallocation of capital can continue. So there are 2 very distinct parts of the economy here. There is the market economy. It's vibrant, it's healthy. It has the same degree of misallocation of capital, which any market economy has, and you're experiencing a little bit of that in America at the moment. But there is the other bit, which has got gross misallocation of capital, which is state-owned industries. They may be withering on the vine a bit, but they're still there, and they'll be a significant portion of the Chinese economy for many, many years to come. So there's no doubt the command economy is growing quicker than the market economy is growing quicker than the command economy and will eventually prevail. Listeners shouldn't be expecting that to happen within 1 or 2 years. It'll be a much slower process. The key difference between China and Russia is that by utilizing their capital controls to control interest rates and the currency, they're producing a slow process of reform, a more gradual process of reform, and a more gradual destruction of the command economy, which is great contrast to what happened across Eastern Europe.
It's certainly, the skeptic might say, yes, but in Russia we saw different periods of glasnost and perestroika all throughout the 20th century, and each time they opened up their economy, allowed for capital flows to come in from the West, they essentially were using that to retool, bolster their economy, and then lo and behold, the command economy came back just as strong, if not stronger, revitalized with foreign capital. How would you argue that this is different? Somehow the market economy how would you argue that this time it's different in China?
Okay. What is reasonably clear in China is that the huge amount of foreign capital which is flowing in and the huge amount of private capital which is generated domestically, we should never forget in terms of the savings which are being reinvested, is really going into sort of one sector of the economy, whereas the government finance is going into another. So in terms of splitting them out, is there any easy way to split them out? Well, not particularly. But if you think of heavy industry and everything else, government funds are targeted towards heavy industry. They're not targeted towards retail. They're not targeted towards mobile telecommunications. They're not targeted towards other things like that. They tend to be targeted towards heavy industry. So it's not as if the private capital is flooding in as yet to massively recapitalize the state-owned industries of China. As you know, China has a share class, a B share class, and an A share class. It's actually restricting the amount of capital it's raising for its state-owned industries to local owners rather than foreign owners. So there's always a risk, of course, that they just simply expropriate the entire market economy. But it's not as if we're bringing in foreign capital to retool the old state-owned industries and get them back on board again. But the risk of expropriation exists in any economy in the world, not just in China. I think it's worth stressing that China is definitely moving forward towards a market economy. I think if you believe that the harmonious society is a consumer society, if you believe that the Chinese leadership is now concerned about consumers or people, and we can't call them yet voters, then I think the move towards the market economy is ingrained. Any move away from that would meet with significant social disruption.
Russell, do you see the free market banking system emerging in China like it did in America after 1919? Do you see those banks being national banks or free market banks, or do you see them from maybe the United States as where the loans are going to be coming from?
Yeah, I think the way these deals are being done is that foreign bankers are putting significant amounts of capital into Chinese banks. That capital is then largely segregated into a subsidiary which deals with specifically consumer finance. So, for instance, the situation with the HSBC Bank of Communications deal is a lot of the capital which has come in is in a subsidiary. HSBC has an option at a time when it becomes legally possible to buy a 50% stake in that subsidiary. So it's a complicated answer, but what's going to happen over the years is you're going to find that the old, badly run state-owned industry bank is going to own 50% of a thriving consumer finance operation. HSBC will own 50% of that thriving finance operation, as will other foreign banks with their partners. So you're still going to have, for many, many years to come, big dominant state-owned banks, but within them very vibrant growth areas, which will be 50% owned by the Chinese and 50% owned by foreigners, and that's the growth area. So you can put that down to foreign finance, and you can put some of it down to local finance. It's a combination of both, but you're looking at little banks within these big banks, which are going to be the growth consumer lending area.
Let's segue a little bit here, Russell. If consumer finance is driving consumptive habits in China and will over the next decade to two, and that causes more or less global, or contributes to global inflation, what does that inflationary effect do to equities? Where does that leave the average stock or mutual fund investor?
Okay. Well, I think the important phrase is global inflationary pressure, because obviously if you believe Milton Friedman, then it will be up to everybody to decide how much inflation they want to have, because inflation is everywhere and at all times a monetary phenomenon. So just because we have higher inflationary pressure from China doesn't mean necessarily we have very high levels of inflation, or levels of inflation we associate with the 70s, when a Keynesian approach amongst Western central bankers was more prevalent. But I do believe that it means higher levels of inflation than we've been used to, and it does mean that several attempts by the Federal Reserve to control inflation over the next decade or longer, which are not good for equities and not good for bond markets either. Let me explain the rationale behind that. I've written a book called Anatomy of the Bear, which looks at changes in U.S. equity valuations since 1881. And it tries to look at the turning points in those equity valuations, and when they're high, what is the catalyst to bring them down to low levels, and vice versa. And what you find is that great high valuations for equities have always been mean reverting to low valuations for equities, and the catalyst has always been inflation or deflation. I should stress that of the four great bear markets in the last 120 years, three of them were caused by rising inflation, and one was caused by an eruption of almost immediate deflation. Be aware that was the 1929-32 episode. Mm-hmm. So I believe that inflation is the key catalyst to bring down equity valuations. They are expensive. I know everybody believes that they're quite cheap. If you look at current earnings, or if you look at prospective earnings, perhaps they look reasonably cheap. But I think the best way to look at U.S. equity valuations is to use a thing called a cyclically adjusted PE, which is what Robert Shiller uses in his Irrational Exuberance book. It's a 10-year rolling average earnings number. It's what Benjamin Graham recommends in security analysis to look at the underlying corporate profitability. If you look at that, American equities are pretty much as expensive as they were in the late 1920s, 1968, 1901. Now, they're a lot cheaper than they were in 2000. Market has gone down a bit. Earnings are up quite a lot. But they're trading at about 23 times cyclically adjusted PE. And at the bottom of a bear market, after inflation has wreaked havoc or forced central bankers to run too tight a monetary policy, then we should expect them to get to 10 times cyclically adjusted PE or below. So this is why I believe inflation is so negative for equities, where it's the catalyst for a mean reverting valuation event for equities. And the duration, I'm sure most people will be interested in as well. If this was an average duration for a swing from peak valuation to low valuation, it would last around 14 years. And given that valuations peaked in 2000, you'd be looking at a bear market for valuations which wouldn't end until 2014. So whether that's just a complete collapse in the price of American equities, which is actually the most unlikely event, or a lower price for American equities plus earnings coming through to bring the valuation down, either way, it's not going to produce good returns, and investors have to hope that it's more via price stability for equities and corporate earnings coming through. But it could obviously be the other way around, and we could see a significant fall in U.S. equity prices up until 2014. So not a straight line decline until 2014, a cyclical pattern, and in many ways a repeat of what we saw from 1968 to 1982, a market which trades from about 600 to 1,000. Over that long period of time, earnings come through, boosted earnings come through, and over that long period of time, valuations come down very significantly.
And with the adjustment for inflation, that's what you're talking about with the cyclically adjusted price-to-earnings ratio. The Dow itself could actually rise while its cyclically adjusted price-earnings ratio is still very unfavorable. Is that correct? That's
absolutely correct. The foreword to my book is written by a gentleman called Mark Faber, who I'm sure many of your listeners will know. And that's the point he makes in the foreword, that actually the Dow Jones Index could go up, but the valuations would come down because earnings would come through. It is very likely in that scenario, however, that we'd have really high levels of inflation. If American corporations are really going to have that strong profit growth, it's probably via rising selling prices. So the purchasing power of your equity market, even if it's the same value as it is today in 2014, the purchasing power of it will be down very significantly. So we could see a situation of rapid declining valuations with no fall in price, but that is only likely in a very high inflation scenario. And I still think that's unlikely. I still think the central bankers will fight inflation. It's just that the fight against inflation, for those who remember it from the 70s, can be kind of painful for anybody who owns equities.
Certainly, globalization changes the financial landscape and it has over the last 5, 10, 15 years. If you look at any of the financial crises we've had in the last 2 decades, it happens one place and the ramifications and repercussions are felt basically everywhere to one degree or another. We're seeing that with the subprime crisis now for very specific reasons. Why is there opportunities in foreign equities or emerging market equities in a context where U.S. companies are suffering? Or is the whole world tied at the hip? Our pain is their pain.
That's the $64,000 question, isn't it? I believe that they're not tied at the hip. I believe in that buzz phrase we have in the markets at the minute called decoupling. I think there's actually evidence of it already, particularly if you look at Asian export figures. I mean, the great contagion for Asia was supposed to come via its export numbers. Now, export numbers are holding up remarkably well. They may not be holding up particularly well to America, but Japan is doing well selling things into the rest of Asia. Everybody's doing well selling things into the Middle East. We are now, I suppose, coming up to 11 months of the subprime crisis, but the contagion is not being felt in Asia as yet. You look at a place like Hong Kong, it's a small place, but you've got 20% retail sales growth, 20% credit growth. I think if we'd all been sitting here last year knowing what was going to happen to the U.S. in terms of the scale of its credit crunch, I think we'd already be expecting some fairly significant fallout in other parts in the world, and there is some evidence that's not coming to pass already. But that is the crucial question. I'd flip it around slightly the other way and put it this way. There are many companies, sectors and industries all across the world that will benefit from inflation, and many of them could be listed in the United States itself. I think you get a very strongly bifurcated market. Look at all the sectors in America that have done well for the past 2 decades, and those are very likely to be beneficiaries of disinflation. And of course, right at the top of that list, one has to have the financial companies. And then look at the companies which haven't done well. And of course, manufacturing companies would be on that list. I'm sure you're well aware of the renaissance in some sectors of American manufacturing. Well, that could be moved to significantly higher levels. Also, inflation is fairly good for companies with very high fixed costs. Now, it may not be everybody's cup of tea to invest in heavy industry, but in a situation where feedstock prices can be passed through, where input prices can be passed through, and you've got a very high fixed cost, many companies in that situation will earn good money. So I think what investors have to think about is inflation. I can believe in decoupling, but I think when you begin to think about inflation, you begin to look at even companies listed in America. You don't throw your hands up in horror at the entire U.S. listed sector. Investors in John Deere will be well aware of some of the good things that can happen when you get agricultural inflation coming through. And there'll be many companies like that all over the world which will benefit from inflation or benefit from selling things to China, benefit from China's demand for commodities, which we're seeing already. So the inflation story is a negative one, but I think the crucial difference with the 70s is this. Inflation won't get to such a high level, but also investors have got many more options than they had in the 70s. So we remember stagflation for all its inherently negative things, because if you lived in America, you invested most of your money in America. Today, there are other places to invest money. There are whole new sectors of business to invest money. And I think that flexibility should mean that investors' portfolios could adapt more successfully to higher levels of inflation than they did in the 1970s.
Now, with your thought that the central banks will actually be fighting inflation with the possibility of raising interest rates, tighter policy, can you just comment on what you think what you feel the effect will be on the bond market generally? So we've been mainly talking about equities, but what would be the effect of bonds, the real rate of return going down due to inflation?
Yeah, well, I have something very controversial to say about the bond market, which is that it's not really a market. I know it is the biggest, most liquid, the U.S. Treasury market, biggest, most liquid financial market in the world, but it is 63% owned by governments. Now, whether that's the American government or the Central Bank of America or other central banks, 63% is owned by governments. Over the past 5 years, nearly 78% of all the incremental new bonds issued have been bought by governments. The biggest distortionary effect on the planet today is the forcing of Asian and other central bank savings into the U.S. bond market, and it's holding the bond yield in America at a ridiculously low level. Now, there are some people, and George Soros is one of them in his new book, who suggest that that's unsustainable, that flow of capital into the U.S. Treasury market will have to end, that U.S. interest rates will have to spike upwards, and that will cause a great deflationary risk to the global economy, because your bond market yields would have to go to true market levels. I don't agree with that at all. I believe that the actions of these central bankers and bank treasuries is fairly much on autopilot, that it will continue, that bond yields will be held at absurdly low levels relative to inflation, and that's going to be the future for many, many years to come.
So do you see these governments monetizing their debt when they can't sell it for real rates of return? Is it a monetization effect worldwide?
I think the American government's going to be quite happy. I think they're going to be issuing this debt at the current interest rate, and inflation is going to be higher than the interest rate. I know it's not what Economics 101 teaches you. I realize that the bond yield should be positive in real terms. The yield should be above inflation. But for any government to be borrowing money lower than the rate of inflation, I think is one way of getting out of a hole, which is very, very nice indeed. And I think one of the great surprises over the next several years will be how quiescent, if we can use the maestro's term, quiescent bond yields will be in the face of higher inflation. And that's not a bad way for governments to get out of a hole just by itself.
It seems that from a historical standpoint, U.S. interest rates have been, over the last 200 years on about a 28-year cycle on average. The shortest duration of an interest rate trend was 22, and I think the longest maybe 37 or 38, but the average around 28 years. So we should, just from a historical perspective, be at or near a bottom of an interest rate cycle and be looking at interest rates rising over the next decade or two. What you're saying is that could be held in abeyance because of central government subsidy, 63% of the bond market being controlled by other governments who are more than happy to scratch each other's backs, as it were, and continue this game forward, keeping interest rates at a low level. Do I understand that right?
Yeah, I think that's absolutely correct. We are in a bear market for bonds, but it could be a very slow one and take a long time. You could be in a bear market for bonds and still have inflation above bond yields, and people will be wondering why it wasn't happening quicker. It could be another conundrum. Anybody who wants to know about this should read The History of Interest Rates by Homer and Scylla, which gives you a very good run-through on the long-term bear market in bonds. I would stress that they can happen very slowly. You'll know that at the end of the Second World War, the yield on Treasuries was effectively pegged at 2.5%. One of the great bear markets, which you referred to, didn't really end until 1981. So right through the 50s, yields were going up, but they weren't going up so materially that it was devastating confidence, that it was actually that obvious that we were in a long secular bear market for bonds. So this forced purchasing of the Treasury by foreign central bankers, I think, will just make that bond bear market a very slow burning one, and will surprise many people how slowly it happens relative to the rise of inflation.
Well, let me just say this. For any of our listeners who would like a primer on the market history here in the United States of the last 100 years, Anatomy of the Bear is an essential read. I personally would put it in the top 10 of books that I've read, and clearly in the last 5 years, that gives you perspective, not only on the inflection points in the market where things are changing, Russell, as you've said, is a consequence of either inflation or deflation, these being key catalysts, but just some of the sentiment that was experienced at these market bottoms. I think for any student of the market, this is an essential piece in your library, and I'd encourage you to go to Amazon.com. Russell, we would appreciate you joining us today and joining our conversation with our clients. Most insightful.
Okay, thank you.